Thank you very much. Let's talk about where we are on Italy. For many in the market, it's way too early to talk about the Eurozone's third biggest economy defaulting. But there's no arguing with the ferocity of the speculative attack and the magnitude of the landslide it's triggering in traders' positions. Fears that Italy's embattled Prime Minister Silvio Berlusconi might backpedal on austerity, plus what stress tests on Italy's banks might reveal, have pummeled Milan's stock market again today. As you can see, we're now down 10% there on just 1 week. The euro today has lost the best part of 2 American cents on just this session. And the stampede out of Italian bonds is sending interest rates, as you can see there, to levels that immediately worsen Italy's long-term trajectory as it comes to the market this week and next. But behind it all, traders tell me, is a growing confidence among those that believe that when it comes to the Eurozone, the emperor has no clothes, and a growing willingness to raise expensive bets against the Eurozone. That's partly because its 17 finance ministers meeting in Brussels today seem to have lost momentum, even now coming perhaps to the conclusion that the $170 billion bailout that they're trying to put together for Greece will be deemed a partial default, a credit event with write-downs and huge implications, as you know, for world markets. If you look across the pigs here, the extra interest that the market demands to hold debt over German bonds is jumping, in some cases to all-time highs. As one German newspaper even suggests, the European Central Bank is contacting, even now, big names on Wall Street to help it deal, the European Central Bank, with the prospect of sovereign defaults which until recently the ECB categorically promised us all would not happen. So for you, as an investor at home, what does it mean? Should you now be thinking about Europe, or importantly, about earnings season, which of course kicks off tonight? Joining us now, Hugh Johnson, Chairman and CIO of Hugh Johnson Advisors, and Mark Lamkin, CEO and Chief Investment Strategist with the Lamkin Wealth Management. Mark, what do you think? Where should people focus? How bad is it?
You know, Simon, I do think that this Italian deal, they're the latest hangover victim of the European debt binge, but I do think it's going to get solved. The question is, are they going to default, or are they simply going to take some haircut on bonds? And I think it's simply haircut on bonds, and therefore it won't spill overseas to the United States money market,
Hang on. Are you talking
with.
about Italy taking haircuts on bonds? Because if you think that won't spill over to the American market, the third largest economy in the Eurozone, I'm sorry, sir, but you're simply wrong.
No, I don't think it'll be a significant haircut. I think they will take a haircut, but I don't think it'll be to the level to where European banks will get in default mode, and that will spill over to the U.S. money markets at that point. And I don't think it'll be that significant to where it will break the buck here at home.
But you know, Hugh, I feel like I've seen this movie before, and it was 2008. And nobody knew how bad it was going to be in 2008. And there's that same sense in the market when, as Simon very aptly pointed out, you see the CDS spreads widen, et cetera, et cetera. So as an individual investor here in the United States, do I duck and cover? Or do I use this decline in the market as an opportunity?
Well, I think it's a little of both. I think the decline's going to be an opportunity. I'm in the soft patch camp, if you may, that eventually we're going to come out of this. Eventually we're going to start to see the market come back to life. We're going to see the economy come back to life. But there's no question that the risks now have gotten very substantial, especially when you bring Italy into the picture. The real question, Sue, in my judgment, is what's going to happen to all of those banks that own that sovereign debt? Are they going to roll over their debt? Are they going to be willing to step up to the plate in the future to finance further expenditures in these countries? What's that going to do to the European economy? So the global growth story, quite frankly, if you look at Japan, if you look at monetary restraint in China, if you take a look at austerity in Europe, you take a look at all the steps there, the move by the president towards $4 trillion in restraint here, all of that adds up to the same thing. Yes, we still have a global growth story, but it's not as positive, it's not as good as it once was. So yes, this will be an opportunity, but just hold on right now. Eventually, I think sometime later in the summer, that's the time to start to add to equity positions.
I just want to make one distinction here. This is Italy. This is the third largest economy in the Eurozone. If Italy goes, does that mean Spain, Portugal, Greece, Ireland? If the European Central Bank, if it goes, I don't think it will go. It's not what I'm hearing in Europe, though the bets are big. It would instantly mean that the European Central Bank was insolvent, Hugh.
No, I don't think so. I think that what we're talking about, I think everybody's accepting the fact that this is not just going to be the public employees. It's not just going to be the taxpayers in those countries. It's now going to go to those that hold the debt of each of those countries. I think the bondholders know that. They accept that. There's going to be a restructuring. That's a euphemism, quite frankly, for a default. But I think all of that's in the cards, and it's being priced into the markets right now. I don't look at this as being a disaster. I look at it as a sort of a slow-rolling adjustment to a very difficult situation. It's not going to be as catastrophic as everybody seems to be trying to convey.
I hope you're right, Hugh. But if that is the case, then Mark, let me turn to you. If Hugh's right and you're right, then where do you put your money? And do you avoid companies that maybe have exposure to Europe? Or if things are going to be okay, do you add to those positions? Where are you putting money to work?
Well, money to work right now, I'm about 50% cash because I do think Italy is a big deal, and I do want to be cautious right now. But I am adding money right now to technology companies that are helping other companies become more efficient, mid-cap growth, and municipal bonds of all things right now. They're a safe haven. State budgets are up 10% year over year. I think you get great values in there right now.
All righty, Hugh, what about you? Give me some specifics.
Well, the specifics are you have to overweight equities because I still think, as I mentioned before, the bull market's further to go. The recovery has further to go. We've got to get it through a difficult period. In the equity markets themselves, again, you overweight equities. I think you have to emphasize the bull market sectors. That's materials to some extent, certainly consumer discretionary, industrials, and technology stocks. I think I would duck international. I would underweight international right now. And in the credit markets, make sure you play it safe there. I really think in time, and again, time is the issue, is that we're going to see interest rates headed higher, so keep the duration of your bond portfolio on the low side. Essentially, small cap will probably be better than large cap. We'll get back to all that. It's just going to take time, a little bit of patience. Everybody just sit tight, hold tight, and sit tight as we move through some of these very difficult problems.
Thank you both.
It's good to talk to you. Thank you, Hugh. Thank you, Mark.
Thank you.
You bet.